Costco Wholesale Corporation, ticker symbol COST, is currently trading at $892.38 a share. Year to date, this stock has been on a massive rise, up almost 37%, easily beating the market and even beating out the likes of Microsoft and Amazon. What we're going to be doing today is going to my automated stock valuation spreadsheet to see if Costco is a buy using discounted free cash flow models, the comparable company model, the dividend discount model, and of course the Ben Graham formula for intrinsic value. So as I said, currently the stock is at $892 a share. If we go year to date, 37% up in that time. Over the last year, up almost 62%, massive increases again, and is up almost 200% in the last 5 years. If we were to compare to the SPY over that similar time, the market is up almost 92%, with Costco easily beating the market. So will this continue to happen? Let's have a look at my spreadsheet. So first, if we just put in the ticker cost, this will load up all of the company's financial data, and we can have a deeper look and see if the stock is doing all the right things. So as I said, $892 a share, a 400 billion market cap, quite a high PE ratio of 55, with the market average being in the 29 to 30 region, currently at 29.5. Earnings per share of $16.13, a beta of 0.78, which is surprising actually, because that means it is less volatile than the market, which obviously is 1, and a target price of $8.85. So analysts are saying it's maybe a sell, most likely a hold. They do pay a very small dividend, 0.52%, which gives you around about $4.64 a share. It's a relatively safe dividend, 2.1 billion, with 28 and 27 payout and free cash flow payout ratios. So let's have a look at this little chart here. We can see we have sort of the breakdowns of the revenue, profit, and cash flow. So let's just have a deeper dive into this. This is going back to 2010, and we can see the revenue has consistently growing, and basically they have made all-time highs in every single year, which is pretty crazy to see. In the trailing 12 months, they are currently have $253 billion in revenue, which is excellent to see. 5-year compound annual growth rate of around about 11%. Profit, similar story. They haven't consistently beat profit each year, but you can see they have managed to you can see it's basically growing exponentially here, and in the trailing 12 months, 7.17 billion with a 14% compound annual growth rate. Next, we'll look at free cash flow, and you can see this is all over the place, but all-time highs once again. The trend is upwards, 7.42 billion. Shares outstanding. You can see that they were previously issuing shares. Sorry, they were buying back shares in 2010 to 2013, but it has maintained this this value right here. So they're not issuing shares, not raising capital, but they're also not buying back shares as well. They're not diluting shareholders, which is good, but obviously they're not buying them back, which a lot of people like to see. Assets versus liabilities. Liabilities are high, assets are high as well, but this has been pretty consistent from 2010 onwards. Right, let's have a look at the discounted free cash flow model. This is a way of valuing companies, estimating their future free cash flows and discounting them to today's value. So based on averages, this actually gives a calculated stock price of $375, which means it is a sell. But let's have a deeper look here. Revenue estimates, we're seeing an average revenue growth rate of around about 8%, with 273 and 295 in the coming years. Let's see what analysts are saying and see if that's in line with their expectations. Yeah, 270. So to be fair, that is a pretty consistent number. They have managed to increase their net income margin. So let's pop that up to 3%. Puts it at a $414 stock, and free cash flow to net income will take an average of the more recent 5 years, which is around about 98%, and that still puts it just shy of a $500 stock. So discounted free cash flow model is not really keen on this stock, but if we look at the free cash flow ratio, 73 and 90, that is not a surprise. Before we look at the comparable company model, if you're interested in this sheet, please check out my Patreon. Links are in the description. Now we'll look at the comparable company model. This is a way of valuing companies, looking at other companies of similar size and similar industry, and the different metrics we are looking at. So we're looking at revenue, revenue growth rate, EBITDA, earnings before interest, taxes, depreciation, amortization, net income, profit margins, price to sales, price to book, PEG, which is Peter Lynch's price to earnings growth, and then EV to revenue, EV to EBITDA, and PE. So let's have a look at some comparable companies. One that immediately jumps out at me is Target, ticker symbol TGT. Next, we'll look at probably the more direct competitor, Walmart, WMT, and we'll go with Home Depot as well there. So what this do is it will load all the comparable companies' financial data to enable us to compare. Home Depot and Costco are about the same equity value with about 366 billion. Target much smaller than these two, and Walmart is a lot bigger. Revenue, Costco is second with 253 billion. This is not the trailing 12 months. Walmart with the highest with 600 billion. But if we do look at the 5-year growth rate of these companies, Costco is in the lead with 11%, then 7, 7, and 4. Net income, it's actually not one of the most profitable ones, 7.2 billion compared to Walmart and Home Depot. In terms of profit margins, it is second lowest with 2.83%, lower than Target and Home Depot, but higher than Walmart. Price to sales, this is the, once again, we want to see closer to 1 is the correct value here, and it is about in the middle of the pack. Target and Walmart are lower than 1, Costco with 1.5. Price to book, similar story again, we want lower numbers better, and actually one of the highest ones apart from Home Depot. Price to earnings growth, what we want to see here is closer to 1, and actually it is the highest, which is quite interesting. Means Peter Lynch is probably not interested in this stock. Now these are the metrics that we're looking at here: EV to revenue, EV to EBITDA, and PE, and we'll look at these and take an average. You can see it is one of the higher EV to revenues, the highest EV to EBITDA, and actually the highest PE. So according to this, it is not a buy, with an average price of $630 a share. Finally, we'll look at the Ben Graham formula for intrinsic value. This was popularized by the father of value investing himself, Ben Graham, and what this does is it looks at the value of the earnings per share of the last 12 months, the reasonably expected 10-year growth rate of the earnings per share, the AAA bond yield, and then the current corporate bond yield. And if we just have a look at the Moody seasoned AAA corporate bond yield, very high inflationary environment, 5.12%. And analysts think that Costco will be growing over the next 5 years, but they're growing at a rate of 9.6%, less than their previous growth. So let's just go 10%, $200 stock. So Ben Graham doesn't like the stock either. So interestingly enough, that the discounted free cash flow model does not like the stock. The comparable company model says it is probably overvalued, and the Ben Graham formula for intrinsic value does not like the stock either. So it would say it's a sell, but I'm sure they would not like those. As you can see, this stock is up almost 200% in the last 5 years, at its all-time highs by quite a bit. Exponential growth since about 2020. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Check my Patreon, and like and subscribe if you haven't already. I'll catch you guys next time.